I think the stock market is always, it's not T20 or Test cricket, but I can be a bit more specific. I think the stock market is always the last day of a test match. It's just that the format of communication has changed. We think that macros are very important, but at the same time, we believe that they are not predictable.
Hello everyone, I am Chanchal Agarwal. I am the CIO at Equitalks Credence Family Office, and welcome to the new session of Equitalks. Today we have with us somebody who needs no introduction, Aashish Somaiyaa himself. He's been instrumental in setting up Motilal Oswal right from I think 1300 crores to almost 43,000 crore over a span of 8 to 9 years. From there he moved on to WhiteOak presently, which is managing around $10 billion of assets. He's been an investor, an AMC guy, and today we are going to talk a little more and understand Aashish Somaiyaa. Who is Aashish Somaiyaa, right? Before I get into that, some very cliche questions about the market, and I'm sure this is probably the 1000th time somebody would have asked you, but my question is, kya lag raha hai, right? Is this T20? Is this Test cricket? Is it a chess where you're trying to manipulate and figure out where this market will be, trying to time your positions right? So first question on that.
I think the stock market is always, it's not T20 or Test cricket, but I can be a bit more specific. I think the stock market is always the last day of a test match. Because, like in the recent times, everybody must have seen India-England, and I think a couple of matches went down to the last day. So, test matches are most exciting when it's a difficult pitch to bat on. And on the last day, the batting team needs to make sure that they're on the pitch the whole day and, bat the whole day and make 200 runs to win. That's the most exciting, right? So, I think stock market is closest to that.
So then my next question to you would be, where will the earnings come from, right? People are excited about markets and you keep tapping the FII, DI numbers. There was a data that got released day before which says that, hey, retail is still going very strong. If markets are strong, where will the earnings come from? Because, do you see the consumption coming back? What is your forte around rural versus urban? There's a lot of charts, data that come across, and I kind of came across the presentation that your house releases where they spoke about the rural recovery. Are you spotting an earnings recovery, or is this just mad market where liquidity is just chasing the top stocks and there was always a comparison between Zomato, DoorDash, etc. So what is your sense around that?
No, see, a couple of things. I think you're right on liquidity, but see, it's like this, that liquidity is obviously not at gunpoint. I think, what has really happened is that in the last few years, three things have happened.
Yes.
Why you are seeing DIs, why you are seeing local investors. One is because if you see in the last few years, the interest rates have really dropped, right? I mean, say 10 years back, it was sometimes normal to see government bond trading at 8.5, 9, 9.5 kind of thing. But in the last few years, we've not seen it anywhere cross the range of 6.5, 7.5, right? So you can say that interest rates are down by nearly 30% from what the high point was. Second is you can see, digitization, and then you can see a lot of young people joining the market. So that is where the liquidity is coming from. But at the same time, we know that if earnings don't keep up, right, if the markets, like say, where we are right now in the last 1 year, the market return is practically zero.
Correct, yes.
Correct. So liquidity is never at gunpoint. It's just that the other asset classes are doing really badly, and equity still over the long term has rewarded people. Compared to one year back, we were very, very concerned about earnings because, GDP growth and corporate performance, everything. I think from there on, there is like you cannot say like a strong recovery, but an anemic kind of, slow recovery. The other thing that investors will also find challenging is that till last year, there was some sector, some theme, something or the other which was really giving fairy returns. But now the market has become mixed up and it's become a totally stock pickers market. Last thing which you said about, a lot of times what is happening is that many companies are making a lot of talks about consumption. My personal opinion is that consumption is not as bad as what is made out to be in the listed space.
Okay.
See, take an example. If you see, say, the consumer companies, say FMCGs. Now, Chanchal, you look at your house, you look at my house, and maybe you can talk to your clients and your audience. The challenge is that the big FMCG companies, They are facing competition from imported brands. They are facing competition from DTC brands. The landscape of distribution which they are used to controlling versus the distribution which you and me are using to access products, everything has changed. So if you go and check your own household, you will not find the prevalence of the big FMCG brands anymore. You will find a myriad set of new brands which you were otherwise not really
Correct.
Consuming. Second, if you see, take all these malls and retailing and apparels, right? We have Indian brands, but you can clearly see a massive influx of foreign brands and, more importantly, fast fashion. So today these foreign brands and the fast fashion ones are cheaper than the domestic
The
brands.
Indian khadis
So what is happening is that the listed space is not reflecting some of the consumer trends, and then obviously the listed head honchos will come and say that people are not having money and they are not consuming, but that's not what is reflected in the general ecosystem that one sees. So I think that rural consumption obviously has been slow. It depends on rainy season and depends on the crop and all, and depends on the government initiatives that are going through. But personally, if you ask me, urban consumption is what one is, or discretionary consumption or urban consumption is what one is betting more on. Like you said, the most powerful man on the planet is actually communicating to you on Twitter or on X.
That's surprising.
So yeah, so the point is that it's just that the format of communication has changed, but I don't think how things work must have changed as much. Now, in the midst of a standoff, in the midst of a negotiation, what one party says to bring someone on the negotiating table, fine, you don't read too much into it. I cannot start changing my portfolio based on one pronouncement made by someone, and at the same time I have to wait for this to get into some direction or something which tells me that there are some conclusions to be drawn out of this.
Right.
On your second point, it's obvious that if the tariffs remain the way they are, then I'm not saying it won't. It will hurt the electronics industry, it will hurt textiles, it will hurt gems and jewelry, right? There are impacts for certain segments. But just like we spoke about the consumption piece, the question is that how much of our invested listed portfolio is impacted by those spaces, correct? As long as services and IT and pharma is not directly impacted. Now say, as a check, even our pharma portfolio I checked, hardly 15% of the whatever we hold in the portfolio, of the entire portfolio, 15% is the exposure to US business. If you take profits and revenue, the exposure in our portfolio is less than 15%. So the point is that yes, it is making headlines, it is capturing a lot of imagination, but then how much is it impacting directly in our portfolios and the listed space? Is it impact more on sentiment? Is it impact more on fundamentals? We have to look at all of these things. So my sense is that the market is not reacting to it because it's like a developing situation, and it is some statements which seems to be made in the vein of negotiating or bringing a counterparty onto the table, that if you don't do this, then I will do this kind of thing.
Correct. I'll pick up a cue from your last conversation, which you said that you have 15% of the pharma in the portfolio, right? Isn't this a difficult time for portfolio managers like yourselves, because you're not only tapping the bottoms up approach, which is finding the right company, the right story. It is at most important for you to get your macros right, to get the top down right, because hey, you could be right on your story, you could be right on the company, but if there is a tailwind that affects your sector, probably then it could be an underperformer in the portfolio, right?
Sure.
So what are these fund managers doing? Are they sizing it right? Have you seen the timing of an exposure to a typical sector or stock reducing? Or are they very agile to this macro event?
Sure. So on the previous one, just want to clarify, what I meant to say is that in our pharma portfolio, the exposure to US is, for the whole portfolio, barely 15% of the revenue or profit gets impacted with US business. The other 85% has nothing to do with US. So that is one. Coming to your more important question, so what we do, every fund house will have a different set of beliefs. On your question on macros, we think that macros are very important, but at the same time we believe that they are not predictable. So it's not that we disregard the macros, but basically, we track and we try to understand macros, and we know that they are very important. But to the extent that they are not predictable, what we will do is we are very clear that our job is to be a relative return manager. Means that under any circumstance, we are trying to beat the benchmark. Our first dharma is to make a portfolio which will beat the benchmark as consistently as possible. So as a result, our focus becomes very relative. Now, when you talk about macros, the way the macros play out, obviously it will impact the benchmark also, because the benchmark is made up of different types of sectors. In a particular macro environment, automatically some sectors will get headwinded, some sectors will get tailwinded. And what we do is that our portfolio is always constructed relative to the benchmark. So if you look at our mutual fund portfolios, we follow something called a balanced portfolio construction, which means that when it comes to factors, by factors we mean growth, value, defensive, cyclical, domestic, exports, PSU and private, large, mid and small. So plus every sector also is a factor in contributing to performance. So what we do is we do a factor balanced or factor diversified portfolio, which means that in the benchmark is not growth or value. Benchmark is a mix of growth and value. So we'll ensure that our beta is closer to 1. We are never 1.2 or 0.8. When you look at sectors also, why we don't take top-down calls is because even sectors, we have certain limits of tolerance. If a sector is say 8% in the benchmark, and let's say the sector, like you rightly pointed, is currently headwinded.
Correct.
Take IT in the current environment, it's actually 8-9% of benchmark. And everybody who has no clue about the market also believes that IT का कुछ नहीं हो सकता है.
Yes, there is AI.
But same was the sentiment for pharma in 2018. Now think logically, who will buy pharma in 2018? We didn't know there will be COVID, but who would buy pharma in 2018? Anybody who did a top-down call, they would never buy pharma in 2018 because they will say US FDA, some 483 notice, some plant under inspection. So in fact, lot of times what happens is the top-down guys make exclusionary calls. This won't work, this will work. Whereas the relative return manager like us, what we say, okay, currently IT is not looking great, or in 2018 pharma was not looking great, but in the worst of sectors, we still have to identify the relative outperformers. So if a sector is headwinded, in the benchmark it is 8 or 9, I may be 5 or 6.
But you still have a weight.
But we will still have the best of the worst. If I think everybody is a pygmy, my job is to get the tall pygmy.
Okay.
So what will happen is that today, let us say when everybody has concluded that IT is not going to work, anybody who takes top-down macro calls will have zero exposure to IT. But someone like us will say, okay, yes, the environment is headwinded, I am not getting enough great ideas. It is reflected that when it's 9% of benchmark, maybe I am 5-6% or 7%. But within that, I will still buy the relative outperformers. And staying with this IT example, if you see in the last year also IT was headwinded, but if you bought small cap IT companies, or if you bought IT companies which were providing services to BFSI space, or if you bought IT companies which were doing good enough of domestic work in India, they were rank outperformers. The same way in 2019-20, pharma was an outperformer even before COVID came. Same way in the last year or so, IT didn't do badly. In fact, if you take in 2024, IT was amongst the top performing sectors, maybe in the top 3 or top 4. So we are a relative return manager. We respect the macro, but we also respect that it is unpredictable. So we balance out the impact of macro by having a portfolio construction which is balanced versus the benchmark. Our active weights are 60%, but all the active weights we create are at a stock level, not at a factor or sector level.
Is it right to conclude that then you would see that the constituents, at least the index constituents, are probably right, and you would want to pick up or size yourself better in the index?
Size ourselves and the exposure, the stock specific exposure. Right? In technical language, what one will say is that as far as systematic risk is concerned, we are balanced with the benchmark. The only risk we take is the non-systematic risk, which is the stock specific risk.
Correct.
So the sector to sector, like you rightly said, sector to sector, we may have plus minus in sizing, but constituents in terms of individual stocks may be very different from what is there in the benchmark. That's why, although the portfolio is well tethered and well geared with the benchmark, it is still 60% active. That is because of the stock level difference in picking.
No, that's amazing, and in fact, I'll kind of delve deep a little more into this because it's the most mispronounced word, which is active, passive, and now you have a new word which is quant. You know, past 2 to 3 years you had all value, momentum, picking up, and everybody swearing on these momentum strategies. Couple of these momentum ETFs, and I don't really want to
G.
name couple of them. People thought that, you know, momentum is the god, ETF is the god, and you just don't need to do anything. Invest in the benchmark, and you are done, right?
Yeah.
I think now we are flipping the phase where we are saying, oh yes, you know, there's quality, value, momentum is gone, and probably, do you think, will you classify quant in a momentum strategy? I'm going to pick a little more on that, because I still do not, I mean, I've met a lot of managers doing quant. I don't understand what a quant strategy, true to label quant strategy is. So what is Aashish picking up? Are you active manager? Will you go for passives with, you know, your ETFs, or do you think that India is delving a little deeper on quant, and probably the next decade would be quants and such strategies?
No, so see, I think, so first on your question, we are clearly active managers, right? And we are heavily focused on delivering, you know, like a high information ratio. That's our main objective. Recently, in April, SEBI made it mandatory for all active equity funds to report information ratio.
Okay.
In simple terms, information ratio is obviously your excess return over the benchmark, which is the alpha, divided by the standard deviation of alpha. That, okay, you're generating alpha, but how consistent is it? How much do you fluctuate between bad times and good times? So I'm happy to report that since the time it has been made mandatory, we are amongst the better ranked, or maybe the top ranked people when it comes to information ratio. So I think the regulator is doing a lot to spread awareness that how to measure the performance of active funds, what numbers, what ratios to look at. And thankfully, you know, whatever strategy I described to you is serving us very well. So we are more in the active space. Coming to the other point, you know, what I find, Chanchal, is that sometimes there is a human bias. When we start understanding something, we start thinking that I will be able to predict it. So let me clarify that. You know, in the last 5 years, like I gave you example of IT and pharma and stuff when we were discussing sectors, in the last 5 years, you must have noticed that 2000 till 2018, all the growth oriented sectors, you know, whatever reported high EPS growth, that was doing very, very well. You know, at that time it was auto ancillary, home finance and those kinds of things. Then in 2018, ILFS defaulted.
Correct.
And there was a credit crisis.
Yes.
So from there on, growth got beaten up, and high quality and defensives, that did very well throughout till 2020.
You had large caps swearing by this,
yeah,
correct?
and large caps and high quality, you know, that is the time when it came, you know, you should only own Avenue Supermarts and Bajaj Finance and Asian Paints and HDFC Bank and those kinds, right?
Correct.
So in the last 5-7 years, what happened? First it was growth, then it was quality. After 2021, when US started raising rates and there was Ukraine war, it became more value, you know. So look at it closely. In 2019-20, people used to think, oh my God, why are you holding all these PSUs and cyclicals? I mean, you know, you're holding junk. And on the other hand, the belief, the given wisdom was you should only own high quality businesses.
Agree.
But after 2021, quality took a beating. It was only value.
Correct.
Right. Then if you see 2023 and 24, what happened was that the market became very polarized. So if you are in small cap, PSU, cyclical, energy, defense, you're a rock star. But if you're in large cap, BFSI, IT, consumer, pharma, you're down in the dumps.
Yeah.
So then people started thinking, oh, it's momentum.
Correct.
So in last 5 years, you've seen growth, quality, value, momentum, very rapid rotation and very stark polarized markets. So then people latched onto it. That, oh, okay, active management, okay, but at different points in time, there are different factors which seem to be driving market performance. Now, just because you can have a observable trend of the last few years, so you start observing that, oh wow, this is how it works. I got some insight.
Now let me do that.
So, but bhai, that is, you got an observable trend from the last few years of data. Doesn't mean you can pick the next trend.
True.
Right.
True.
That's why I said that if you start understanding something thoroughly, right? I may be a commentator of cricket, and I start understanding very thoroughly that on this pitch, this kind of batsman will work, on that pitch, that batsman will work. That doesn't mean I can become a batsman, right? So sometimes when people get a thorough understanding of something, they start thinking that I'll be able to predict in future also. My learning from whatever I described to you is that yes, factors do drive performance from time to time. The learning is that you should balance your portfolio for factors. The learning is not that you should try to predict the next factor. And the last thing I'll tell you that, whenever you try to pick these factors and momentum, etc., you are a research person, you will realize that there is no back test which ever failed.
Yes, backtest in hindsight is always right.
Right? Nobody launches a product and nobody presents a presentation to their esteemed clients showing a backtest which failed.
Correct.
So everybody who launches such a product comes with a backtest, and the backtests all look fabulous. So I think that, just like macros are unpredictable, how market reacts to macros is unpredictable, and which is the next factor which will rule the market is also unpredictable. So you are better off focusing on your asset allocation, balancing for sectors and factors. And there are books and books written on this. Just like there is a lot of literature on factors, there is enough literature which says that when you are delivering fund performance, it's a mix of luck and skill.
Correct.
When you catch the macro, when you catch the right sector, it's a function of luck. When you do bottom-up stock picking,
that's skill. Yeah.
It's a function of skill. So we are here to outperform based on skill. We cannot claim luck as a achievement of skill, because whatever return the market gives you because of your such calls, the market will take it back. What will remain is only your skill. So sometimes our returns get tailwinded because of alignment with macro. Sometimes our returns look outstanding because the macro tailwind has aligned, and apart from skill, the luck is also adding. But whatever is added to our return because of luck, let me assure you, market will take it back. The outperformance which remains is only the outperformance from the relative stock picking. So all of us should really focus more on that.
I like how you flipped the question, and you escaped answering, but I'm going to try my luck again.
No,
this
please.
time with an
If
asset
I miss
allocation.
something, happy to answer. Yeah.
This time with an asset allocation, right? I mean, you've been very vocal of, and you did mention right now as well, that you need to asset allocate right, right, to get the optimal return. If somebody has to asset allocate today, you would always go underweight on certain asset class, overweight on certain asset class. What would be your point of view that if you're building a portfolio for a decade, let's put it for a decade, how would an asset allocation portfolio look for the general investors, and what is your personal asset allocation portfolio?
Sure. So see, look, obviously you deal with affluent and maybe wealthy and high net worth investors, right? Now clearly what happens is that when somebody is a individual investor, young person starting out with an SIP, then obviously they are looking for growth orientation, so they would be in equity and they would try to save as much as they can. But when we are talking about high net worth investors, I presume that the purpose of the wealth is to grow it at a reasonable rate but also preserve
the capital. Yes.
So for rich people, high net worth investors, generally I have seen they are not dependent on the portfolio for their bread and butter, and generally I have seen that they all are not trying to quadruple the money in 3 years, and they are all trying to grow it at a acceptable pace like 10-12%, and they are trying to ensure that they don't lose any wealth, right? So from that perspective, asset allocation becomes very, very crucial. Now, if you really ask me, there would be say 4 or 5 components, right? I mean, Indian equity, international equity, most people would have say real estate. You might recommend to them to have gold because wherever you have equity exposure, gold is a great volatility dampener. And then of course you will have fixed income. Now, family by family or individual by individual, you are more equipped than me. You know that this would vary. But in today's environment, if you ask me 3-4 things which I can think of, one is that investing outside India. I would say investing outside India, international equity should be 2 parts. It should be US and it should be non-India or ex-India emerging markets.
Okay.
Right? So because all of us have a preponderance of India in our portfolio. So let's leave India aside for a moment. Everybody is allocated. On the international part of it, I think I said US and emerging markets ex-India. So US personally, if you ask me, it's been on a dream run for post the Lehman crisis, it's been on a one-way movement. Even COVID was, I think, 45-day affair for them. Otherwise, they've been on a tear. And now they are probably hitting a kind of air pocket or turbulence, with their economy and their economic conduct itself. So I would for the moment desist from allocating to US. But emerging markets other than India, one should really look at seriously because of 2 or 3 reasons. The first is, you'll be positively surprised to know this, that India's correlation with emerging markets other than India is 0.6. And India's beta vis-a-vis the MSCI Emerging Market Index has consistently been declining. So we are becoming more and more a market which operates very differently and has very low correlation with other emerging markets. And that is because if you see the other emerging markets, say Middle East, Brazil, Indonesia, etc., they are commodity driven. India does badly when commodities do well. Then countries like China and Indonesia, they have a large domestic economy which has nothing to do with us. Then there are export oriented countries like Latin America, some parts of say Vietnam and China, etc., which are export oriented. Then there are tech driven markets like South Korea and Taiwan. So this is the reason why India has poor correlation with emerging markets other than India. So all asset allocators, all HNIs should have emerging market exposure.
Sure.
Now currently RBI has limits, so maybe you facilitate it through LRS or you do it whichever way, that is your discretion. But I think US, which I think you should evaluate after a year or two, or you should stagger your investment, but the clear one is emerging markets ex India is a great opportunity. The other thing is that if you really see nowadays, one thing I want to point out, I read it somewhere, that in investing, I'm coming to fixed income and gold, that's why I'm saying this. I read that in investing, the biggest mistakes happen when people chase high returns in an otherwise low yielding environment.
Okay.
So today what has happened is your FD rates are 6%.
Correct.
Your government is borrowing at 6.5%, and you likely said inflation is also low,
tapering,
right?
yes.
So the mahal is that you will get 6% if you don't take risk. So why will you find instruments? I mean, the home loan rate is below 8% now, right? So why will you get 17, 18, 19 or 20? In today's environment, who will give you 18, 20%, or who will borrow at 18, 20%, or which instrument will give you 18, 20%? The risk-free rate has gone down. In last 10 years, the risk-free rate has gone down from 8, 9 all the way down to 6.
6, yes.
So our India's beta and India's risk premium has also gone down. Our inflation has gone down. As a country, we are now heading to the 4th largest economy. Our sovereign rating is stable. So when the risk-free rate is down and the risk in the environment is lower as a country, the returns you get will also be lower. The problem is that everybody is thinking they should get 18, 20%. They are not getting acclimatized to 12% or 10%. So actually in today's environment, fixed income is not necessarily a bad investment. We have to bring when inflation was 7%, you were getting 9%. Now inflation is 3%, so you will get 6%. No, why will you get 9%?
Correct.
So what is happening? People have to start focusing on the real return. Move away from nominal returns like 1920. So 2-3 things to keep in mind when you're asset allocating. I think if you have a big equity portfolio, you need gold. And if you have gold in the portfolio, it better be 10, 12% or 15%. Some people say that gold is ornamental. So in your financial portfolio, either you say I don't believe in asset allocation and I will be an equity guy. So then it's fine. Or you say that, okay, I want wealth preservation, I want low volatility, I want asset allocation. Then you better do asset allocation scientifically. And the science and the statistics seems to suggest that if you have 2, 3, 4, 5% gold in your portfolio, it's going to do nothing to shield you with 50-60% of the equity volatility. If equity is 50-60% of your portfolio, then gold better be 10-15% of your portfolio. So what I feel is that the Indian equity should be India, US and emerging markets. You should be okay with getting lower return. You should be having fixed income and gold. So all of these things people need to keep in mind. And when it comes to real estate, I think a lot of criticism about rental yields and residential and all. I think that's a mirage. In India, I think commercial real estate is doing fabulously well. It's the only asset class which gives you leverage. It's the only asset class which pays for itself, right? So commercial is something which people should have in their mind, or REITs in which whatever works for them.
Sure, I think that's very interesting. I'm going to take you to one of the, I think, media presentations back in March 25,
Ji.
where I think one of the questions that popped up was, how should you plan your new equity investments? And
Yeah.
that's where you said that it's best to stagger over a 3-month period, right?
Yeah.
While I understand it is more qualitative and judgment call where you
Ji.
say that, but what are these indicators broadly that you look at which gives you that sense whether should you go all in now, should you stagger for 3 months, 6 months, or you now need to asset allocate deeper into fixed income and gold, and you mentioned EMs as well, right?
Ji.
How do you predict that inertia?
So little bit of contrarian thinking. So let us say, for example, why did I say emerging markets? I think that if you take last 10-15 years, US has beaten the hell out of emerging markets on a relative basis. And all of us are lucky we were in India, because after US globally, the second best performing market in dollar terms is India only, right? But if you look at the China, Indonesia, Brazil and Latin America of the world, they have underperformed miserably, right? And they are not as bad markets as they are made out to be, correct? So we were lucky that our relative performance is good, but otherwise if you are a contrarian thinker, then emerging markets will make a lot of sense. That is one. Second, in March 2025, for example, if I said that you should stagger for 3 months, then maybe in hindsight that turned out right, because April, May was very bad for markets. But I should have said 6 months, 9 months staggering, not 3 months, because if you see the market I don't think the market is out of the woods.
Right.
So
you still think market is not out of the woods?
No, I don't think so. See, one is because it's clearly there are no trends, or there's no trend, or there is no sector, or there's nothing in the market which is really driving the market. It's totally a stock picker's market. So if you take last 1 year, if you're a good stock picker, like let's say in last 1 year, the index return is now, if you take BSE 500 index return is negative. And we have some relative outperformance, so our performance is low single digit. Okay, but the market is doing nothing. I mean, if you see, everybody is discussing tariff, but we are bearing the brunt of tariffs and all for last 8-9 months. Even if domestic conditions have improved, the external environment is quite bad.
Correct.
So as a result, I think we are not yet out of the woods. We are still bearing the brunt of, not just US economy, US economic conduct itself, right? And then the geopolitics, correct? Plus, of course, if you see our own earnings, it's been high single digit and low double digit and those kinds of things. And it's a totally stock pickers market. There's no trend. I mean, in every sector you might find some good performers. It's like that. So I still think that you should stagger. I mean, and where does one get that sense that you should stagger? One is that, you observe how people are thinking. Like I always tell people that, where the market will go, that is not predictable.
Correct.
But wherever the market is, how people are conducting themselves, there are a lot of clues in that. So why I said a lot of clues. Take an example. Why did I say this, that, people should tone down return expectation, get used to whatever I said. Because abhi bhi aap dekhiye, you take Association of Mutual Funds data, even today 70% of the net flow is going into sector fund, thematic fund, momentum fund, small cap fund and mid cap fund. Correct?
Correct.
So that shows that people are just chasing high return. People don't seem to realize that 1 year return is zero. And the market is not where it was.
The play. Correct.
Yeah,
Agree on the
market
sector
is
parts.
Market is not where it was. There is no trend, or I mean, what makes you believe that you should still keep buying all this, some multi-factor, momentum, uske pehle energy, defense, infrastructure, PSU. 3 times I said that there is no trend in the market. It depends on your stock picking. But still people are chasing some make-believe trend and not noticing that the market is, practically zero return. So people need to be careful, and there is a lot of hint in how people are behaving itself. Correct? So, market is not predictable. How people behave gives you a lot of clues.
Got it. We'll try and understand Aashish as a person, learnings from the past, and probably pick up a couple of cues that we could use in our lives, right?
Yeah.
Motilal 1300 crore to 43,000 crore and now at WhiteOak. What are these learnings that you think is a no compromise for you? How did it dwell on you as a person? And what are these changes that you have brought in yourself as a person which you think you should have come a little early in your career?
Yeah, I mean, that's a very interesting question. I think, over the number of years, what one has learned, and what, I mean, it would be great if I had learned, say, 20 years back.
Right.
Say, for example, one clearly is that, all of us, I mean, okay, let me say, speak for myself, not all of us. Say that, someone like me, like I used to be a quick decision maker, impulsive, sometimes emotional, uh, you know, uh, say temperamental, right? Now, over the number of years, what one learns is that, never think that people around you don't know what they are doing.
Hmm. Okay.
Generally, what I've learned is not to judge anybody. And what I've learned is that whatever anybody is doing, there has to be a reason or a background or where they are coming from as to why they are doing what they are doing. Okay. The other thing is that so what is this related to? This is related to the fact that you learn to see the world the way it is rather than trying to see the world the way it should be or what your notion of what
perception
it
of,
should be, right?
should be, yeah.
So I think these things come when you see more and you age more, right? And I think if I knew these things, I would have done much better, much earlier, and I would have caused less pain to or less trouble to a lot of people. Right?
I hope all your juniors are listening to
Yeah,
this,
yeah.
but that's amazing. But tell me something. There's so many changes that has happened on the regulatory side, good, bad aside. SEBI has come, has drawn a rule book in terms of how mutual fund industry needs to function.
Yeah.
They started from the categorization to now, right? If you had to pick up one rule which you think has really shaped the industry well, what would that rule be? If you had an option of being on the SEBI chair and changing one rule and removing one rule completely, right? What is it that you would to introduce? What is it that you would remove, right?
Sure. So, just one thing, like, when we were discussing the previous point, I just wanted to say that, what I've learned as a result of all of that I shared, what I've learned is always hold back your reaction.
Okay.
Okay. Like, give
Pause.
yourself like 5-10 seconds, hold back, absorb, and then
React.
respond or whatever you call it.
I think that's much needed because all of us have an habit of just reacting
Yeah.
on the situation and then you
Responding,
realize,
yeah.
okay.
But yes, now you asked me a more important and very difficult question, which is that if I had anything to contribute from a regulatory perspective. See, I don't know if this falls within our capital market regulators domain or it falls in the larger
ecosystem.
ministry or the ecosystem. But I feel that, in generally it is happening that in our quest for catching 1, 2, 3 or 4 bad guys, we perpetually penalize pretty much all the good guys. So you will relate to this very well that if you see, if you have a bank account, if you have a mutual fund or anything, one of the things we are doing is perpetually doing KYC.
Oh yes, that's a pain.
Yeah.
That's a pain.
Now the point is that you know my tax returns, you have my bank details, you have everything of mine. Right? I mean, what will change every 2 years for
Nothing
me
really.
to report back, where
Correct.
every 2 years I have to give my Aadhaar card and PAN card and get the KYC. Right? And we are perpetually creating multiple databases of KYC. And I think this comes from the, prevention of money laundering and, the FATF and all those kinds of requirements where India is signatory to many global treaties, etc. I know we want to keep the system clean. We made a lot of progress, right? As a society, we are using less cash. The number of people filing taxes is going up. Direct tax collection is going up. So I think, in the quest for catching few bad guys, we should stop painting the whole system as bad and, see, because compliance has become extremely expensive, correct? So if there is always perpetually an army of people trying to collect people's PAN cards and Aadhaar cards, I think it's not the most productive thing to really do. So one is to, somehow simplify that, where I can do some self-reporting or, self-certification, correct? And I take the onus on myself to make reporting if there is anything which changes.
Correct.
That is one. The second thing is that, if you see, when it comes to the overall, apart from KYC, what happens is that we are making a lot of rules whereby then, people, like I'll give you an example. We need to review the rules is the simple submission. say you're a research person, you're a product person, you'll appreciate that there is a definition of what is large cap, what is mid cap,
Correct.
what is small cap. And my humble submission would be, and which we have formally also requested the industry, is that this was 2018. In 2018,
Yes.
the entire equity industry was 16 lakh crores. Today, that is now 48 lakh crores.
Correct.
Right? Maybe 18 lakh became 48 lakh. So I do feel that our investment universe needs to be reviewed. Correct? Because it's not great for the whole industry to put mid cap fund in some 150 stocks. That's just a simple example. So I think that we are making rules which are very good, which are keeping the system safe, but I think they need to be reviewed.
Agree. In fact, a small cap which starts from I think 250 first stock.
Yes. Yeah.
The market cap by itself does not really fall into a definition of small cap, and which
Yeah.
is
I
why
mean, these
the
are big,
variance.
in 6-7 years, the market cap, the market cap has gone from 2 trillion to 5 trillion.
Correct.
So obviously, like you are rightly pointing out, what was the market cap of rank number 251 then and what is the market cap of rank number 251 today, I think must be up by 2x or something like that.
So
2
that-
to 2.5 times maybe.
That needs to be recategorized.
Yeah,
for,
we need to review the universe, right? I mean, we are covering 1,000 companies. We are not covering 300, 400 or 500. So how will fund houses invest more in research and cover more companies? And how will capital allocation improve is if you remove these or relax these categorizations.
Okay, and the first question, what do you like? What are the regulators done which you really admire?
Very, ease of doing business is a perpetual agenda. So I really admire that. I think that we should give due credit to the fact that our regulators have played a huge role in allowing or enabling everything to be digitized. I can assure you one thing, today if you go to any of our regulators and you say that why do you need paper for this? Why do you need signature for this? That's the first thing they'll pick up. They'll say, okay, get rid of paper, get rid of. They want everything to be digitized. I think that across the board is a genuine agenda which I can sense as a market participant. The other second agenda which I really admire is inclusion. So see, I think the mutual fund industry gets credit for it, but I can tell you, being an industry person, I can tell you it was mooted by the regulator, which is to say that put 0.02% for investor awareness and education. No industry in the world spends 2 basis points of their corpus trying to educate people about how to invest and how to do it, debt, equity, SIP, mutual fund sahi hai. There's no industry in the world which does this.
Correct.
Right? So our regulator has told us to set that money aside and work on financial inclusion. And we are living in a country, the importance can't be overstated. We are living in a country where people lose money to plantation schemes and whatnot. People lose so much money to unorganized schemes. So in our kind of country, it is very important to do all this mutual fund sahi hai and investor awareness, because if the regulated product doesn't reach, then the unregulated guy is going to reach there definitely. So, digitization and investor awareness, I think they are very, very, very clued on to it.
Point on.
It's their absolute top priority, and I haven't seen it changing in the last 10-15 years. They're really at it.
In fact, I'd love if you could elaborate a little more on that. And my next question to you is, you mentioned mutual fund sahi hai, right?
Yeah.
There are a lot of campaigns that talk about that. Earlier, there was a campaign which said that hold the right stock and sit tight around the right stocks that you might have around that. If you have to point out couple of misconceptions that the investor might have because of this, right? So, what is the common misconception that you've come across? Because now there is so much retail money that has come into the system. So generally, when you talk to your relationship managers, people on ground, clients, and you realize that this is not this. This is a common misconception that needs to change the way we look at investments. What would that be?
Couple of things. I think investments and I think misconceptions more related to investors also.
Investors, yes.
What I found is that, see, I'll tell you something funny. Our industry demands that people like us, like say someone like me, our industry and our regulation demands that we have track record and experience.
Yes.
Which means that most people who are in the industry, AMC guys, fund managers, CXOs, all of us, we all are, 50s and north of 50s. But we should be aware that the guys, the customers are all 25 and 30.
Yes.
Incrementally, the millions of new SIPs or broking accounts that come, those people are 20 and 25.
Yes,
they are not 50 and
absolutely,
55.
correct.
But the guys managing their money and tasked with communicating to them, they are all 50 and 55. So what is the biggest misconception that people of our generation or people who are the AMC guys or the broking guys, what's the biggest misconception? They'll keep on saying that, oh, okay, all these young guys, they've come in the market because the market is booming. They've come after 2020. They don't know what they're doing. If the market falls 20%, they will run away. Bhag jayenge, right?
Demat accounts and number of demat accounts, etc. which is started.
It is a humongous misconception because all of these 50-year-olds are looking at today's 20-year-olds and thinking that they will react the way I reacted when I was 20.
When I was 20. Okay.
Yeah, huge. I mean, I can tell you, I find it so funny. We are probably the only industry in this world which consistently berates and criticizes our own customers or underestimates our own customers. Which industry does that?
Nobody.
Right?
Yes.
So, who are you? Why are you randomly issuing warnings about market girega, sab bhag jayenge? I mean, after 2020, the market ran up by October 2021. It became 18,000. So, in COVID, it was 8,700. In October 21, it was 18,500. In June 22, it was 15,200. That's a big fall. Then it went up. In Silicon Valley, so it went up to 19,000. When Silicon Valley happened in 2023, Nifty was 16,600. Right? This year, 2025, at the beginning, small cap fell 25%. Right? In 5 years, there have been 3 times when some or the other part of the market is down 15, 20, 25%. Kaun bhag gaya? There are still broking accounts opening, there are still SIPs happening, and there is still a strong flow. So, the investors that we have, young people today, they are much smarter than what we think.
What we were.
They are better educated. They have better socio-economic profile. They have seen longer history of the market. They are in a much better regulated environment. They have more knowledge and more information. They know what they are doing. So, I think major, you said, myth or misperception is with industry participants. And our clients are much smarter.
Okay.
Clients are much smarter, I think. Right?
Okay,
so that we should keep in mind.
I take that. You said disclosures, and a 20-year-old in me now wants to ask Aashish that I'm starting my career, Aashish, and there's a fact sheet that a fund has given me. It says it has a lot of disclosures, and mutual fund nivesh ke adhik hai. I in 17 years have not read a single disclosure page, right?
Yeah.
So when I look at a mutual fund fact sheet or any fact sheet for that matter, what are these prominent things that I should have an eye on and I should keep tracking, right? So what are these key items that Aashish looks at?
So see, I think first is that what you said is a compliment to the regulator and the industry, because aapne kya bola that in 17 years you never read a disclosure. It means, Chanchal, that you have implicit faith in the system.
In the system, yes. That, you're so governed with SEBI that system mein kuch nahi jayega.
So you have faith. This is how it works.
Exactly.
Right? You have faith in it.
Right.
So that is the first great part, that the system has established the faith. Now coming to what one should look at. See, first of all, there is this challenge that if you invest in a mutual fund scheme as an AMC and as industry, what is the challenge? One challenge is that if you have invested in XYZ scheme of ABC, AMC, Chanchal, what you will find is that other than XYZ scheme, you will get information about every scheme. You check your mailbox, TER change, key management personnel change, new NFO launch,
correct,
fact sheet, presentation, market view,
correct,
budget,
sab milega,
election.
Yes.
But the scheme in which you have invested, uska portfolio aapko...
And you don't get data. I mean, at times you have to literally go and ask that, what have you done in the 1 year? Explain me that.
Correct.
You don't get that
so
data.
You should ensure that you, first of all, as an investor, you should ensure that you make your thought process and what you're looking for, make it clutter-free. You only consume the information. See, you must have spoken to a wealth manager, advisor, or a mutual fund distributor, or whoever you consult, or you may have read something online or whatever. For whatever reason, you made decision to invest in a particular fund. Now you make sure that you are spared all the clutter and you focus on where you have invested and understand that better and form a relation with that. So the first thing I will do if I am an investor is that before making a decision, I'll be sure that is relevant for me. I will understand it. And after having made that decision, I will try to understand it better and better, and not just draw conclusions based on what I am receiving in my mailbox, or not draw conclusions based on last 3 months or last 6 months of performance.
Right.
So I think everybody needs to spend more time in understanding the investment which they have made rather than getting distracted with what is happening around them. That is very important. To form a relationship with your investment is very important.
So listen to the fund manager and not really the key data points that are.
Yeah, I mean, there's so much of information being thrown around. It's not all relevant.
It's not really relevant. If there is one book suggestion that you would like to give to everybody who's listening to us now, what changed your thought process? And if there's, I'm sure there are lots of books, but if you had to name the key ones, which ones would that be?
See, I observe a lot and I read a lot about behavior of people. And I'm sure you know this, that even the Nobel Prize in Economics in last 20 years, I think 2 or 3 times the Nobel Prize in Economics itself has been given to people who study human behavior.
Oh.
And not interest rate, exchange rate, supply and demand. That itself is a big hint, right? So I feel that everybody, there is a perception. We spoke about misperceptions. The other one is that there's a perception that in our industry or in fund management or in money management, there's too much of maths and rocket science. It's not true that way, actually.
It's 80% humans.
It's 80% emotion.
Emotions, yes.
So I think that if you can read up or if you can understand, if you can learn to observe your own emotions. The beauty about human beings versus animals is that we can think about what we are thinking and we can analyze and evaluate our own thinking and feelings, right? So if you observe how you are feeling, right? Let's say somebody tells you there is this hot new investment and you feel really compelled to invest. You need to think what you are thinking. You need to step back. Everybody says be greedy when others are fearful, be fearful when others are greedy.
How do you follow that?
Then so the only thing you can follow that is that you need to self-evaluate. Is the crowd acting greedily? Am I getting drawn into the crowd? How am I feeling? Am I part of the others or am I part of the crowd? So I think people should read up a lot on behavior, less so on maths. Maths is the fund manager's job, so don't labor yourself with it. Focus on the behavior part of it. So there are books like, say, Predictably Irrational. It's written by Dan Ariely.
Okay.
Then there is a book called Persuasion, The Art of Influence,
okay.
Written by Robert Cialdini. Then all these books like Daniel Kahneman, then Richard Thaler, Nudge.
Nudge, yes.
So all books which help you understand human emotion, human behavior, what drives emotion, how to think, how to analyze. I think those are very important.
Oh, awesome. I think this is damn interesting. And before I let you go, one last question that pops up in my mind, right? If you had to conclude our discussion in a 2-3 liner and give it as a takeaway to people who are listening, what would that be?
I think that you asked me very interesting questions and a very wide-ranging conversation, but 2-3 things I would urge people to look at. One is don't get drawn, the last part, don't get drawn so much with the mathematics.
Mathematics, yes.
Because everybody who comes on TV and talks is all IIT, IIM, really smart people. But don't get so much drawn into the maths and the complication. Focus on your own asset allocation, focus on your own emotion, focus on what is, it's a very internal process, managing money and asset allocation and stuff. So focus on yourself. I think that is one very important thing. The second thing is obviously, when you say be greedy when others are fearful, be fearful when others are greedy, the important word is others. So you should know whether you are part of the others.
If you are the others or you are
exactly. That is very important. And the third thing I think is that, in our country, we are all blessed to be in a place where if you take 32 years of history, every long range compounding is 14-15%, which means on an average every 5 years the market doubles. In good times 3 years, in bad times 7 to 8 years, right? So the key is to stay put. If you just, what you need is discipline. It doesn't need so much talent. So we are blessed to be in a market where market itself doubles on an average every 5 years. So, you don't need to do too much. You just need to be there.
Just have a simple, boring portfolio and I think you
Yeah, people talk about Amrit Kal. No, Amrit Kal to aayega. Tum tab rahege ki nahi, that is the important. Whether you'll be in the investment or not is the key part. That's the point, yeah.
No, I think that was amazing. Thank you so much for sparing time and talking to us today. It was immensely insightful and I'm sure whoever is listening to us will also find it very helpful.
Thank you.
Thank you so much, Aashish.
Thank you.